Hello everyone, welcome to the update Snipex strategy. I know many of you have asked for this video and you've been looking forward to it. I thank you for your patience. I've been thinking about it a little bit over the past several days. I just want to capture as many insights that I know about the strategy as possible in this video so that you get the latest and hopefully the greatest update of the Snipex strategy, the one that I created, and this is called the new and improved Snipex strategy. Again, let me start with the disclaimer. This is a strategy that is newly created by me. I just created it in August 2019, which is just about 4 months ago, and until today, which is mid of Jan, it had been almost like 4 months. The initial results of the test has been very positive. I can tell you that. Okay. Now let me show you how positive it is. Let's first start with the account that I show you. Remember, I have a small account on standby, and I use it to test out the Snipex strategy. And the account started with something like almost like $3,000, less than $3,000. In fact, it started at less than $2,000, but I grew a little bit. So this is the statement in September last year, which I showed you in the previous video. So I grew the account from less than 3K into more than 7K. So it essentially tripled the account in a matter of 1 month, right? So during that time, I felt that this is something big and it could be a very powerful strategy for me to scale up and make a lot more money from this. So post that month, September, I continue to test the strategy through October, November, which, you know, someday I have some drawdown, someday I have some big profit. But at the end of the day, it is growing. The account continues to grow. That's why in last month or so, I decided to top up about 30K. You see $30,000 here. I top up. Essentially, my capital is 30K plus $3,000 at the beginning. And guess what? This is end of December, which is about 2 weeks ago. The account has grown to $56,000. Okay, from 32 to 56. Which is about 24K, 25K. And this same account today, which is on 17th of January, 2 weeks later, I show you the live account. It has grown further to about $59,000. So that's how I keep growing my account with Snipex strategy. Very powerful, very profitable, but again, cautiously optimistic right here. So while the results are very positive, the strategies have not been tested over extreme market conditions. For example, in the market where SPX drops by 50 points per day. No, it have not been there. So I need to prove also the strategy need to work in that environment, right? So I will need to see how it withstand in that tough market condition. So because of that, I would like you to continue to test this out for yourself on paper account, or if you want to use your real money, then start with small money first before you commit any significant capital, right? So just advice to you to be cautious on this. Now, talking about the result, I share with you additional data here. Here's the data that I have been tracking over the past 105 trading days. So from August 19, 2019 to January 16, 2020, which is yesterday. So in total, it's 105 trading days. Now, during that period of time, I started with a small account, but then I added additional capital. So on average, the capital that I use is about 28K. And by the way, not only the account I just show you, I also use the extra buying power in other mixed account to trade Snipex as well. So in total, I've been using about 28K for both accounts combined over the past 105 days. Now, and the profit from both accounts has been very good. 48.684. So almost 49K over the matter of 4 months, right? That translates into about 174% return on investment. And if you divide that into 4 months, which have about 20 trading days per month roughly, that translates into about 33% per month. Again, this is not 33% per year. This is 33% per month. Very good results so far. And we are talking about 30K capital right here. It's not like tiny accounts anymore, right? So let's keep doing. Here's my key points. Number one, I created this strategy since 4 months back. Since then, it has evolved a lot through all the fine tunings and improvements that I continue to make almost every day. Okay, I fine tune the strategy. I bounce the idea back with Adam and Elson, my fellow trainers there, and I came up with some different version for myself. Adam may have his own version, and this latest version has improved the consistency of my profit generation significantly. Yes, I'm sure, and I tell you, this is not the final update. So I continue to improve it, and hopefully I can continue to update you in the future. Okay, now the second point here is very basic, because some people ask me on the Telegram. I just want to put this out here so that it's settled. Now, a SnipeX strategy can be constructed as a directional trade or non-directional trade. So for example, if you want to place a bullish trade, then you just need to select the strike price that is above the current SPX price, the current market price. Okay, so if you select a higher strike price, that is a bullish trade. On the other side, if you want to construct a bearish trade, just simply choose a strike that is below the current market price. If you do that, you will have a negative net delta for the trade. And if you want to be absolutely neutral, then you just select at the money, which is the current market price of SPX, and you have the neutral delta. So very basic on how to construct a bearish, a bullish, or neutral trade using the candle spread of SPX here, right? Point number 3. Conventionally, when people construct a calendar spread, if they want to construct a bullish trade, typically people use the call option to contract the bullish trade, right? So in that case, you would select out of the money call option. Both legs, you have a call option out of the money, and that is a bullish trade. And similarly, on the bearish trade, people tend to use put option at the lower strike price than the current market price. That means you also choose out of the money put option for the trade. So that's a conventional way of constructing a candle spread. However, you can use call option to construct a bearish trade. At the same time, you also can choose put option to construct the bullish trade. Or you can choose either of them to construct a neutral trade as well. Now the market is opening, okay? So again, you can use either call option or put option to construct a bearish trade or bullish trade or neutral trade. It doesn't matter. The P&L looks the same. I can show you on the platform. Right now the market has opened. Let me just show you. Let's say SPX right here. So today is Friday, and normally on Friday the new combo for SnipeX is open up and you can start trading. The rule is you need to sell Friday and you buy on Monday. So the new one will be on 21st, and you notice that 21st there are two series here. One is AM, which is expire in the morning of Friday. We don't choose it. We choose the one that expire after, right, at the close of the business. So that is 21st. And then if you sell, let's say you do bullish, let me exclude some of the parameters here to make it clearer. Okay. So for example, now you want to construct a bullish trade when the price is now 3323, you will do 3350 and you sell Friday, right? Call option. And you buy 24th, which is Monday, call option, the same strike price, just hold the control key. Here's the two legs. Sell Friday 3350 and buy Monday 3350. And you pay a debit of 1.3. If you check this one on the P&L, right click, analyze the trade, and you only analyze the trade that you are constructing right now, you will see the P&L like this, right? Very typical kind of spread. So now, but instead of doing a call option, I can use the put option to construct a bullish trade, right? Just now, if I use a call, I pay about 1.1 or 1.05. Now, if I just change the call to the put, you see that the premium is almost the same or slightly more expensive in this case, but the P&L look pretty much the same, right? So the highest point here, also you make a max profit of $1,000. If you change to call, you also make a max profit of slightly less, so 900 something, almost the same. And the max loss is what? $100 here if you choose call, or 110 if you choose put. You lose maximum 125, slightly different. But the P&L, the risk profile, almost the same. Again, you can use the call option or you can use the put option to construct either bullish or bearish or neutral trade. Doesn't matter, right? But there's some watch out. I show you. Here's the watch out. If you use call options for bearish trades or puts option for bullish trade, okay, so you use the inverted way, and you only do it if the price is cheaper, the entry price is cheaper, then you do it. But the watch out is if you use the call option to construct a bearish trade, that means you use a deep in the money option, call option, to construct the trade. That means you expect the price to drop towards that strike. And if it is the case, then you make money. Now, if the market continue to go up, and the call option in the money there continue to be in the money and even get into even deeper in the money. So in that case, the liquidity of the option becomes very dry, very difficult to fill. So if you want to close that trade, because the expiration is coming, it's hard to close, very hard to close. You hardly can close at a market price. And by the way, the market price is very wonky. It jumps all over the place. You really don't know which is the right market price. So that's a watch out. If you keep that trade until expiration, you may be nervous closing the trade. Or even you have to close the trade at a debit, right? So when you open a candle spread, the max loss is predefined, which is the premium you paid. Now, when you close it, you have to pay extra money. So that means you lose more than the max loss. So that is a watch out. Now, for me, I can manage this because I don't normally keep the trade until the last day. The last day where liquidity is very low. I close it about 7 days to maximum latest 2 days before the expiration. So liquidity is still okay. And also my rule is I close it as long as the strike gets outside the 1 standard deviation range, I close it. So it's not a problem for me. Okay, but if you don't feel comfortable with that, don't do it, right? Ideally, when it goes out 1 standard deviation range, close it. and because you will lose maybe a little money or sometime, and many times actually, I can close it at break even or even small profit. And the last one is a must. If you still hold one trade until the expiration, and that trade happens to be in the money, you must close it. You must close the trade before the expiration, no matter what, no exception. Because if you don't, what happens? The in the money Friday option will be expired on Friday, and SPX is a European type. You will not take any assignment. There will be a cash settlement. And because the option is deep in the money, you have to fork out a huge cash to pay for that settlement. And that is not even worse. The worst thing is you hold the long option that expires on Monday. And on Monday, what happens? What if when the market opens and it gap down significantly? You will have a hefty loss on your long option as well. So never keep your snapback trade through the expiration. You have to close it. And to be safe, close it about 7 days, 5 days before the expiration. Okay? Now, how snapback strategy generate profit? How profits are made in this strategy? Very simple. That is just buy low and sell high. That's simple, right? Buy low, sell high. And let me get into it one by one. First of all, buy low. How can you buy low? The rule here is you buy as early as possible. You know, every Friday, the platform open up the new combo for you to trade. The new combo for snapback is you sell Friday and you buy on Monday. So today is Friday. It just opened up the new combo here and you can see it. Yesterday this combo was not available, but now it's available, which is selling Friday 21st and buying Monday 24th, right? So this combo. Yesterday this one was not available. The next Friday there will be another combo, which is to sell 28 and to buy March something. Let me see. 28 of Feb, which is on Friday, and to buy March 2nd, which is my birthday, by the way. But March 2nd is not available today, so you cannot trade that combo yet. So wait for next Friday to trade. So that's my rule. Enter as early as possible because the price is cheaper. Yeah? So that's how you can buy low. Second rule is you buy when VIX is low. VIX is low, meaning the implied volatility of SPX is low. And ideally, when VIX is below 14, that could be a good time to buy. But when VIX increases to 15 or above, I would not want to enter any new trade anymore because it's considered as elevated implied volatility. Now that is applicable today. Now when I created this strategy back in August, the VIX at 15 is a norm. Almost every day is around 15 or even higher. So that at that point in time, 15 is okay to enter. That's why at the original strategy, I always talk about the entry price of less than $2. But now $2 become too expensive for me, right? With lower VIX, I would like to enter something like $1 or $1.2. That's it. But in the future, VIX can be back to 15, 16 as a norm. And in that case, I would be flexible to change the entry rule as well. But for now, less than 14, I consider. More than 15, I would pass, right? In terms of entry price, this is my rule, right? Adam may have slightly different rule, but for me, I like to choose the strikes that are within 0.5 SD range. Okay, in that case, I pay $1.2 or lower. Now, but if you go for like the traditional, the original version of snapback, which is to select a strike near the 1 standard deviation range, then you need to demand for a lower price. So ideally like $1. On the put side, maybe you need to pay a little bit higher. Okay, and I will consider whether I choose put or call, whatever it is, as long as it's cheap. but I just need to note the watch out that I mentioned in the previous slides. Now that's how to buy low. How to sell high. Sell when VIX surges. And then more than 15 or 16, that's good time to sell, to offload some of your position, take profit. Number 2, I would close any trade that the strike price has gone out the 1SD range. Now just note that the 1SD is shrinking every single day. I show you the formula later and explain why is the case. But the 1SD range at the entry is not the same after 1 week or after 2 weeks. It will be shrinking, right? So whenever the strike price of a trade goes out of the new shrinking 1SD range, I will immediately close it. Often I do it with a break-even price, or sometimes with a small profit, sometimes with a small loss. Depends on how long I have been in the trade and how much theta has been earned, right? Sometimes I got even like good profit as well. So the idea here is I kill the one that goes outside and con the rest inside the 1SD range and let that SD range running towards the expiration, because doing that you would maximize the impact of the theta, which I will talk in the next slides. And then I close everything ideally 7 to 2 days before the expiration date. That's where the sweet spot for me to take profit. Now let me explain the 1 standard deviation range. Now in this strategy context, we refer the 1SD range to the particular Friday option, the short leg. Remember, we always have 2 legs. I'm talking about the 1SD range of the short leg, the Friday leg, right? And if you look at the option change, the one that expire on Friday, let's say the immediate one will be, I call it week 1, and the following week we call week 2, the week 3, week 4, and week 5, right? And you notice that this is the Friday. That's why in my position I have the short position, it's in red. In the Monday I have long position that is in green. So the formula of the SD is the square root of the remaining DTE, which is date to expiration, divided by 365. Okay, so that's one element of the formula. Time the volatility of SPX, and time the SPX price itself. Okay, so there are 3 elements that determine the 1SD. So let's get into one by one. The first element is the remaining DTE. I press the word remaining, so every day passes, the remaining DTE becomes shorter and shorter. So it's shrinking, right? Because of shorter and shorter DTE, the 1SD will be shrinking as well. So 1SD shrinks as time passes. So that's one element. Number 2, the shrinkage actually accelerates when the time moves towards the expiration. The closer to the expiration date, the remaining DTE is closer to 0, and hence the shrinkage becomes faster. Just notice that when you keep the trade close to the expiration, the SD range will shrink very fast. And if you follow my rule, then you need to shoot the one that goes out fast, right? Otherwise, you could be losing money on that trade as well. Okay, so one element. If you notice, when it was in week 5, the 1SD is around 114 plus or minus from the current market price. The week after that, it reduced to 99. The week after that, it reduced further to 82. The week after that, reduced to 67, and then 44, and so on and so forth. And it quickly go to 0. That's how the 1SD range shrinks. That's one element. Element number 2, the implied volatility of SPX, which is VIX, surge will widen the 1SD range. So if the implied volatility increase, the 180 range value will increase as well, right? But if it crush, then the 1SD range will also shrinks, right? So just keep in mind, when you enter when VIX is low, and then when VIX increase, it increase your 1SD range and your trade become more profitable. On the other hand, if you enter at the time when VIX is high and when the VIX is crushed, it will shrink your 1SD and you could be losing money as well. Okay, one more point I want to make here in terms of premiums you pay, what is considered as cheap, what considered as expensive, right? So in the chart I'm showing you here, actually I plot the premium curve, the option premiums curve of SNIPEX trade across different DTEs. So if you look at the x-axis here, I have December 13 put in a solid line, call in a dotted line. So call is always in dotted line and put is on the solid line. One thing you notice that the short DTE, the 1SD range is very narrow. So it's very short from here to here, that's it. But for the long DTE, the 1SD range is very wide. And on the y-axis, that is the premium per share. I mean, this technically is not share. SPX is not ETF or stock, right? So you cannot call it share, but I like a better word, I use share, dollar per share. So if you enter early, which is you enter the January 10th here, you would pay somewhere about $1 per share, very low. If you enter somewhere in the middle, December 27, which is a red line here, you pay a little bit more. Maybe you pay 1.4, 1.5. If you enter very late, you pay about $2. And if you enter extremely late at the last few days of the expiration, then you have to pay something like $6 per share, right? Within the same expiration, SNIPEX premium, which is the net of the long and the short legs, highest, if you notice, is highest at the money. Okay, regardless what DT is at the money, you have the highest premium. That's why when you choose a little bit further out of the money or deep in the money, you pay less. But if you choose within 0.5 SD or close ATM, you pay higher. Number two, entering SNIPEX trades earlier is cheaper. As I mentioned here, you enter like 4 or 5 weeks out, you pay about $1 or 1.1, 1.2. If you enter the last week, it will be very significantly higher. If you take out the last week, the week one here, you also see that, so the week one is very unique. That's why I want to keep the trade until the last week so that I can have my option premium to increase from 1 to 2, and to $6. But again, when I want to con my trade until the last week, the SD range will be shrinking and then I could be outside this range as well. So there's a plus and minuses there. If you want to be greedy a little bit, you be careful to manage your strike to be within the 1SD until the last few days of the expiration, right? Point number 3 here, if the strike stays within the 1SD range, which is shrinking, the longer you keep the trade, the more profitable it will be. This is a point I just mentioned earlier, right? We want to keep the trade as long as possible, as close to expiration as possible, because that's where the premium will shoot up. So you buy low and now you sell high. But be careful, because if it suddenly goes out the 1SD range, the profit from $6 now drop significantly to 3 or even go to 0 very quickly. So you need to be balanced. Continue on this thought on the premium, cheap versus expensive. In a market that is selling off significantly, typically I could see that the call options are cheaper than the put option. Okay, when everyone wants to sell the stock, then the call option tend to be cheaper. So in that case, if you go and you check out the put or call, you see calls are typically cheaper than put. Not for all DTE, in a certain DTE only. So in this case, for example, the dotted line here, Feb 7 is the cheapest one. It's the lowest here. And the put is a solid blue line. It's more expensive. This particular Feb 7. But it may not be the case for others, right? Now, on the other hand, when the market is trending up, puts option tend to be cheaper than call. Then in that case, you may want to use the puts option to construct both trades. And at the expiration or near the expiration date, you know what? The disparity between the put or call actually converge. It's almost the same. You see at the expiration, the last one, the green line here, put and call disparities almost disappear. So that's the reason why when I enter, I choose the one that is cheaper. So that when I keep it towards the end until the expiration, the disparity will disappear, and then the cheaper one will perform better in terms of return on investment. Now, one more point I want to make here on the theta effect. I study to see if there's any difference between the theta decay effect between using call options or put options to construct the snapback trade. And the conclusion that I have is actually there's no difference. The pattern is the same. The pattern between using put or using call, the theta effect is the same. Now, there's one common thing between the two is the theta is highest, which is good for us. It works in our favor when the strike is closer to at the money. That's why I want to keep the trade as close to the price as possible, because the theta will be the highest. And every day passes, it brings me more money. Okay, so keep the trade with strikes as near to ATM as possible. Number two, the theta is higher in the shorter DTE spread. Okay, so look at the green combo here. The theta is higher. So the closer to the expiration date, the theta will decay faster and it works harder for you. That's also the reason why I want to keep the trade as close to the expiration as possible. And the last point I want to make here is if the strike goes out 1 SD range, theta can turn negative and it works against us. That's the reason why whenever it gets out of the 1 SD range, I shoot it, I cut it, I kill it. And I keep only the one that is within 1 SD range so that I make sure that on the trades that I'm holding have the positive theta, which bring me money every day. Okay, so close a trade when strike goes out of the 1 SD range. Next, the implied volatility impact or the Vega impact on the snapback trade. Now, SPX or S&P 500 index has a unique product for it, which is VIX. VIX is an index that measures the 30-day implied volatility of SPX. So it's very unique animal, and because it's so popular, people create a VIX index to just measure the implied volatility of the S&P 500 index. So when VIX surge, that means IV of SPX also surge, the premium become expensive. Remember the formula that I showed you earlier, right? So when IV increases, that will widen the 1 SD range. And then the whole premium curve here will also be elevated. It used to be lower, but because the VIX surges, it goes even higher. So in that case, you pay higher at the time when VIX is higher and 1 SD is also wider. But then after that, VIX drops, or we call it VIX is crushed, premium will collapse or reduce or cheaper. That's where you lose money, right? So better be patient and wait for the right time, which is low VIX, to enter. So buy when it is cheap. So when VIX goes up, then it's time to sell. And you have the benefit of VIX going up, then SD widen, and then you also make more money from that as well. Now, let me show you my statistics based on the trade that I've been doing so far to see the correlation between VIX performance and my snapback's performance. This is based on 105 trading days data. Here's a chart. During that 105 days, VIX was up 47% and down by 53%. Not rightly so, right? Market was trending up. I was surprised that the day when VIX was down is not higher than 53, but that's the data, right? VIX had been down only 53% versus 47 when it was up. Now, interesting finding here is when VIX is up, almost 70% of the time, my SNIPEC portfolio will make profit. So SNIPEC up means I make profit on that particular day. So there's a very strong correlation between VIX and SNIPEC's profitability. So VIX is up, 69% chance that I will be profitable on that particular day. It doesn't mean that when VIX is down, I will be losing. Okay, when VIX is down, 57% chance that I will be losing money as well. So strong correlation between VIX direction and my portfolio profitability as well. Now, there was 53% chance when VIX was down, but my portfolio was up 43% during those days. It's not bad. Okay, so overall, my SNIPEC trade has been up 55% of the time. When the day when I was losing money is only 45%. Okay, so that's the statistic number just to show that the VIX increase has a positive impact to my SNIPEC portfolio profitability. All right, so let's go straight to this very, a lot of people ask me this question on why I choose the strikes that are closer to the ATM compared to the original version when I choose the one that is near to 1 SD range. To make it easy for you to memorize, I create the name 2 mountains or 1 mountain. The 2 mountains is the own original version when I will select the strikes which are near to the 1 SD border. Here's the option change. Right now, the price is at about 3316. Okay, maybe a little bit too small here. So 3316 is the current SPX price. And I look at the February 21st, which is the one just opened up, which is 5 weeks from now, 35 days here. And as I look at the 1 SD range indicated by the platform, it is about $103 plus or minus. So from the current price, 3316 plus 103 or minus 103. That is the range of the 1 SD. So if I plot that 1 SD range on the option table, you will see that this is the current price, 3315 or 3316 there. And then 103 point down, that gives me the first one that is inside the 1 SD, which is 3215. Anywhere between 3315 and 3215, 100 points there. That is a 1 SD range. And I just draw a 50% SD or 0.5 SD dotted line there just to visualize it. On the call side or on the bullish side, I do the same thing. I plot the 1 SD range. I assume I use the call for the bullish. And it is between 3320 and 3420. Also 100 points higher. The other one is 100 points lower. And I also plot the half of the SD line right there. Now in the own version or the 2 mountains version, I would typically choose the strikes that are near to the edge of the 1 SD range. Why? Because it's cheaper. Okay, the further out of the current price, the premium will be cheaper. So I would typically choose something like 3315, 3312, nearby there. Let's say I choose between 0.8 to 1 SD, that range, for the bearish side. Similarly, I will choose also the one that further out in the call side, near the 1 SD range there, and also 0.8 to 1 SD for the bullish side. That's how I used to construct a SNIPEC trade before. If I do that and I plot on the trade on the P&L chart of Thinkorswim, I would typically see the graph of 2 mountains. Okay, you see there? Here's the current price. I expect the price to move either way, up or down, to fall into my profit zone. Either the bullish profit zone or the bearish profit zone. The thing here is, you see there's a dip in the middle. I call it the death valley. The death valley is where the price is not moving anywhere and time is running out, and you could possibly lose both sides. So that's a disadvantage of the two mountains approach. Now, let's continue to stick with that two mountains approach. The same chart I showed you earlier. Now let's play scenario around it. Scenario number 1. Two mountains construct and the price now moves, and at the same time passes and then 1 SD range shrinks. So price move, let's say it moves up from 3315 now up to about 3375. So let's say it moves 60 points up. And at the same time, because time passes during that time, and the 1 SD range also shrinks, right? So 1 SD range for the bearish, because it's a new price now, the 3370, and because the 1 SD range is now smaller, you will see the SD range for the bearish side move up, but it's also narrower. On the other hand, the 1 SD range on the bullish side also shrinks, but it also moves up together with the price, right? 1 SD being plus minus from the price. So that's why you see the whole 1 SD range shifted together with the price. But it's also shrinking at the same time. So what happened in this scenario? Definitely the trade on the bearish side here will be way off the 1 SD range. For two reasons. The price has moved past them. Number two, the 1 SD range has shrunk. So those trades on the bearish side will likely be losing money, and you need to close it. On the other hand, the bullish trades now well within the 1 SD range and it's closer to the at the money. So actually become very profitable. So this is the original version. When you do this, this one can make 100% profit or 200%, sometimes 300% profit. This one you cut loss when it lose 50%. Sometimes you lose everything if you don't cut loss fast enough. Okay, so that is the own approach. Price move, you make more money on the profitable trade and you lose less money in the losing trades. Now, what if the scenario 2 happened, which is the price is stagnant, and at the same time the SD range shrinks because the time passes? Okay, so the price is the same, but notice the 1 SD range now shrinks, and it makes both the bearish and the bullish trades going outside the 1 SD range, because the 1 SD range now is smaller. So in this case, you could be ending up with losing both trades. And that's exactly what I call it, the death valley. When price is stagnant and the time passes, and then you lose both sides. So that is the disadvantage of the two mountains approach. Now, my latest and my preferred style right now is the one mountain, or I call it one great mountain or one giant mountain style. The same chart, the same price, the same DTE, and also 103 or 100 plus minus in terms of standard deviation. This is the range, the same chart, right? The same $100 down, and in the middle I draw the line 50% 1 SD range. On the bullish side, I also plot the 1 SD range. I also draw the 50% line right there. Now, instead of choosing the one that is closer to the outside of the 1 SD, now I choose the ones that are closer to the at the money, as close as possible. Both sides, on the bearish and the bullish, very close to at the money, as close as possible. Sometimes I call it a spectrum of 0.5 SD, because this is a 0.5 SD, this is 0.5 SD, right? So the whole spectrum of the 0.5 SD. And if I plot those trades on the Thinkorswim platform, P&L chart, it will look like a one giant mountain. Two mountains are now consolidated into one, and the big one. In the middle, there's a huge profit peak right there. And what I'm expecting is the price continue to be in the middle somewhere there, so that the pink curve will become a blue curve at the end, and I make the max profit or nearby there, right? So that's my theory. Now, that is theory. Let's also play scenario. Scenario number one, what if price moves the same way it with the two mountains scenario? Also move by 60 points from, or 50, 60 points from here to 3370. At the same time, the 1SD range also shrink because time passes. Same thing for the bullish side. The 1SD also moves because the price has moved and also shrinks at the same time. So in this case, you notice that the bearish trade that I entered there will now go outside of the shrinking 1SD range, the new one. And every time it gets out of that range, I shoot and kill it. Often I get a break even or sometimes small loss or profit. That's fine. But I will kill those trades that get out of the 1SD range. What happened to my bullish trades? Interestingly, because of the price move, it used to be a bullish trade. Now it become bearish trades, right? Because the price is right here, and the strike price are below the market price, so the bullish trades have turned into the bearish trade. But it's still within 1SD range, which is the bearish 1SD range. It just turned from bullish to bearish, but still within 1SD range. So in this case, this trade will turn to bearish, and they should be very profitable. On the other hand, the one I close here could be a break-even trade or losing trade. Depends on how early I kill that. That is scenario number one. Price moves, I lose or break even in one side, and I make money on the other side. Now, scenario number two, what if price is stagnant at the same time the SD range shrinks? This is the best. The price stays the same, but now SD range shrinks. My trades are still within 1SD range. Same thing for the bullish side. The range shrinks, but my trades are still within the new 1SD range. So those trades, both bearish or bullish, both are profitable. So that is the advantage of the one mountain approach. Of course, there are some disadvantages that I don't have it here, but like, as I say, I need to test it further. For example, what if the market drops by 50 points per day? It can be way out of any profit zone that I laid out here, but that needs to be tested. Just to summarize the two approaches that I mentioned earlier, the two mountains style, the entry rule here is you choose the strikes that is further away from the at the money, often at closer to 1 SD or 0.8 to 1 SD range. And because you choose the further out strikes, the price is typically cheaper. You can stick with the rule of $1 or lower for a bullish trades, $1.4 or lower for a bearish trade. And often you have much lower than 1.4 for sure if you enter early enough. The exit rules for the two mountain style is every time your strikes get outside the 1 SD by 20 to 25 points, you close it for small losses. Don't delay the action because you could lose more if the strike goes out too far away from the 1 SD range. Close it. Now, because when you select the strike at entry, you select the one that near the border, right? So a small price move can make the strike go outside the range already. That's a disadvantage. So once you close the losing trade, you also need to close the opposite trade to lock in the profit, because the opposite trade now is closer to ATM, and then it should be more profitable, and then you can close the profitable trade to offset the loss that you have on the losing trade, and often you have more than enough, right? You can achieve like 50, 100 or 200% return on investment for the profitable trade. That approach is also fine. The advantage of this approach is because you choose further out strikes, the price is cheaper. You also have, you look at the P&L, you see you have two profit zones, the two peaks and two mountains. And therefore, if the market whipsaws one way or the other, it may work better. It go into one mountain or it go back to the other mountain. So either mountain will work for you. So in that market condition, it probably works better using the two mountain style. Now, the disadvantage of the two mountain style is the death value. If the price doesn't move anywhere, it's stagnant, and the more time passes, the more money you lose. And also the other disadvantage is any small move in the price will cause some of your trade going outside 1SE range. So you need to close it often at small losses. And if the price stagnant, you could be losing both sides. I explained earlier. Now, I know some of you prefer to enter the two mountain style trade as a double calendar, meaning you choose two puts, two calls, and 4 legs in total. You enter the trade as a double calendar. That's fine, right? I used to do that as well, but I really don't see any significant benefit of doing it. But I see the other disadvantage, because if you have a 4 legs trade, it's harder to be filled. So I prefer to break it into two trades, two single calendar spreads, because it's easier to be filled that way. And then for me, I manage the trade when it goes out the SD range, and if I manage it as a single calendar spread, I can manage it easier. I don't have to look at the opposite trades. Now that is two mountain style. The one mountain style, just to summarize, you select the strikes that are nearer to ATM and ideally within 0.5 SD. And because you choose the strike that are near to the ATM, the price is typically more expensive. My rule is I'm not going to pay anything more than $1.2. Anything less than 1.2, I see it reasonable. And many times, if I enter early enough, I can get like $1 or 1.1 max. That's it. Or sometimes you even get 0.85, right? Now, there's some exceptional case and apply for both styles. When there's a 3-holiday combo, because Monday is a holiday, right? So Saturday, Sunday, and Monday are holidays, and therefore the combo should be sell Friday and buy Tuesday instead. In those combos, the price are typically more expensive. Okay, instead of 1 or 1.2, probably you have to pay 1.4, but that's fine. Like the case of the February 14 and February 18 combo, because the holiday in the middle, the February 17 is a holiday, so there are 3 holidays in 2 strikes, and the price is more expensive. But other than that, typically I enter with $1.2 or less for the one mountain style. Now, on the exit side, my rule is I will close any trades immediately when the strikes goes out of the 1SD range. Often I close it for a break even. Okay, many of you ask, how can I get a break even? Because after you enter and theta start to work for you, right? You earn some income already, but now you have to cut loss, and that income is enough to cover the loss. But there will be cases where you just enter and then price move significantly, and then for that particular case you may have to close at a loss. Now, for the rest of the trades, which is the one inside the 1SD, I will hold those trades until as closer to the expiration as possible, but not too close. I will typically close the rest of the trades anywhere between 7 days to latest 2 days to expiration. Because if you keep it too close to expiration, remember the 1SC range shrinks very fast, and your trade can turn from profitable trade into a losing trade very easily. So don't be too greedy. Get like 7 days, 6 days, 5 days, and you get 100%, 200% profit. That is good enough, and just close it. Now, disadvantage of the one mountain style is you enter at the slightly higher prices, as I mentioned. You have only one profit zone instead of 2. And if the price really whipsaws a lot or moves a lot, it could force a lot of trades outside of the 1SD range. Okay, so this particular style may not work very well in that market condition. But on the other hand, the advantage is very big, right? You have a once huge profit peak in the middle of the zone. And in the case of the market like not so trendy, it's stagnant and in consolidation, this approach works very well. Or even in the market when it's trendy but trendy slowly or steadily, you can always adjust your delta by some of the technique that I explained in the next slides to make your delta neutral again, and that would still keep your portfolio in the middle of the profit zone. Now with this approach, typically I enter as single candle spread with two legs, easier to be filled and also easier to manage it going forward. Now, to summarize my preferred style, I like the one mountain approach. I want to keep overall snapback portfolio delta neutral. Neutral means the delta is near to zero, as close to zero as possible. To avoid what? To avoid having to guess the market direction, because I don't know tomorrow market will be up or down, right? No one can predict the market, so I just keep the delta neutral. Important thing is I just want to ensure that my portfolio has a very positive theta, which works in my favor. Ideally, each trade in my portfolio should have positive theta as well. So how can I keep each trade to have positive theta? Very simple. Keep the trades that have the strike near to ATM. I'm sure and guarantee those trades will have very positive theta. And hold them as close to expiration as possible to maximize the effect of theta. Now, any trade that goes outside the 1SD, I kill it. Because if you let it go too much outside the 1SD range, the theta can turn negative. And finally, on the trade that I hold, I will close everything within 2 to 7 days to expiration to avoid either the risk of the market sharp move in the last 2 days, which can make my trades going outside the 1SD range and become a losing trade. And two, in case of using the inverted approach, I use a con to construct a bearish trade and market continue to go up, and now this is going to expire today. I will be panicked to close it, and if no one fill my order, then I have to close at the debit. Then in that case, I may lose more than the max loss that I have defined in advance. So just want to close. You have enough time to act before being rushed towards the expiration. Now the last one, I want to make sure that I have a good positive Vega. So typically when you enter a snapback trade, you long Vega. But the way for you to maximize the Vega is you enter more trades when VIX is low. Increase the exposure, increase the number of trades or the size of your trade so that you have more Vega. The Vega is more positive. So when VIX goes up, the Vega will work in your favor. Right? So those are the elements: neutral delta, positive theta, and positive Vega. Finally, this is a tip that I have. Many times when I'm not so keen entering a certain trade, I just place a trade out there at the market price, or many times I place 0.05, just one price lower than the market price, and I just leave it there and go to sleep. Many of them get filled during my sleep, so you get a good price. Okay, so that's a tip for you. Now, question is, how do I manage my portfolio delta to make sure it is neutral? Because when market moves, the neutral delta portfolio can become bearish or bullish as well. Let me use the pendulum analogy to explain the concept. So let's say right now the market price is at 3300, and price can go up, price can go down, nobody can predict it, and I maintain my portfolio delta at 0 or neutral at the position number 3 right here. That is the current situation before the price moves. Next, price moves up. It happens these days, right? Price moves up. My portfolio used to be neutral delta, now suddenly become negative. So my portfolio become bearish portfolio. I need the price to move back down for me to be neutral again. Okay, so price goes up, turning my delta into negative. If it continue to move up further, then my portfolio continue to become more bearish. Okay, that's how the market move dictate the delta of the portfolio. And by the way, this pendulum thing is applicable only on Canada spread, so which is the SnipeX. For other strategy, it may not work the same way. So scenario number one, how do I bring the delta back to neutral when the market goes up and my portfolio becomes negative delta or bearish? Step number one, I will close on the trades that the strikes are now outside the 1 SD. Meaning, because price moves up, my bearish trade goes out of the 1 SD range, I shoot it, I killed it. So I close the negative delta trades. So bearish trades is a negative delta trade. So I close it, so my portfolio used to be negative, now become less negative. So portfolio delta moves closer to the neutral. That's step number one. Now, if that is not enough, step number two, I need to add more bullish trades, which is a positive delta trades, on top of that, to increase my portfolio closer to zero. Assuming you still can get a cheap premium. If it's too expensive, you need to close more trade on the bearish side. The optimal entry rules are applied. And how to balance? Do we need to balance by DTE or the overall portfolio would be fine? To me, priority number one is to balance the total portfolio. Then after that, consider the buy DTE to see if you can balance by DTE as well. But it's not a must. It's not critical. You just need to make sure the overall portfolio delta at neutral. So this is how to visualize it on the P&L. The price used to be here, 3300. Now suddenly price move up, and my delta used to be right in the middle of the giant profit peak here, but now it goes to back down to the hill right here, and that's how my portfolio delta is. It's negative, okay, very negative delta. I need the price to drop back to the center of the mountain, so it's for me to have a neutral delta. If price drops back down, that's great, but if it doesn't, guess what? I need to take action. Action number two I can do is I close the bearish trade. Now those trades are out of the 1 SD range. I close it. I cut those trades. In a sense, I move my mountain up. And then if it's not enough, I need to add bullish trade on the upside. Also move the mountain even further towards the price direction. Okay, so I typically need to do these things to balance out my portfolio. But sometimes the price moves too fast. I always have some lag behind. But anyway, next day I take action to balance it out. So after I make the adjustment, my mountain has now moved and it's closer to the new price. That's how I adjust my portfolio delta. Now, scenario number two, instead of moving up, now price drops. My portfolio delta used to be 0. Suddenly, it becomes positive. So I have a bullish portfolio. My delta is so positive now. So I need to adjust the delta to make it more bearish. And the same approach, but just the reverse side. I close on the bullish side, the trades that are outside the 1 SD, I close those and make the delta closer to neutral. If it's not enough, I add more bearish trades on the downside to add more negative delta to make my portfolio even closer to 0. And again, same thing, portfolio delta is prioritized first and then the delta by DTE later. Okay, so basically those are the latest updates that I want to talk about. I also know that on Telegrams, people ask some other question on some other thing on the SnipeX. Maybe I just quickly go through it. So some people ask me, hey, I'm trading SnipeX using my Interactive Brokers account. How can I monitor my SnipeX on IB platform, right? So, and yesterday, Leona, one Option Iron Strikers member, have brilliant idea. So he suggests the approach what I'm going to show you right now. Okay, so just go to your IB account. This is the account that I have in IB. I don't have any SnipeX trade here, but I just give you the concept and then you can do it by yourself just to monitor your SnipeX on IB. Just go to the plus sign here to add a tab. right? And then click on the layout library and click into analytical, and at the bottom of that you see portfolio risk. This is one of the layout they pre-designed for you, pre-set up for you. Just choose the portfolio risks and add the layout. You add the layout and you unlock it, and here we go. Now if you have SnipeX trades, you will see the SPX position here, and you just open up one of the position there. You see the detail leg by leg, trade by trade, right? And the beauty of this is you can see the delta, the portfolio delta, right? If you look at this one, for example, if this is a SnipeX, I have 211 or 213 delta, so it's positive for me, right? So you can monitor your SnipeX using this layout. And by the way, when I'm here, I show you I'm trading different stock, and one interesting one, and you may know it, 3690, which is Meituan Dianping, which Adam has recommended. I trade options on Meituan on Hong Kong Stock Exchange, SEHK here. I trade using calendar spread and also diagonal spread, and the trade has been very profitable. I'm making good money on it. So just one question that people ask, and by the way I want to address it here. Let's go back. Next question, option fee. So people ask me about what is that index option fee that Thinkorswim charged us recently. And I answered it on the Telegram chat group, but I just want to emphasize it here. Starting last January 2nd, 2020, Thinkorswim or TD Ameritrade started to pass the fee, the index options fee, to on traders. And they told me that before that they was absorbing the cost. The SPX trade become popular now and they want to pass those fee. And they told me that is a CBOE fee, it's not their commission, and they want to pass it rather than absorbing it. Now, the fee that they charge us will be 0.54 per contract if you trade SPX weekly, which is the Friday and Monday, and the premium is more than $1, which is most of the case, right? We trade like the in the money, out of the money, and premiums are very rich. It's not the net premium of the two leg. This is a premium of per leg, so it's definitely more than one. 54 cents per contract. So if you trade one spread, which is 2 legs, that's $1.08. And they will charge you both when you enter and when you exit the trade. So it becomes $2 plus. Now $2 plus here for one spread per contract. It's not per day. Somebody confuses per day. It's not per day. Only entry and exit. Now 2.16 sounds a little bit big, but if you divide it by 100, because one contract is 100 points or 100 shares, right? It translates into about 2 cents. So that is your additional cost, and that will be on top of your regular commissions. Whatever commission you are paying today, you will be paying 0.02 on top. Not much, okay? Because when market move, you see the minimum increment in SPX is 0.05. This is less than half of that. So it's okay. For me, it's still acceptable. Now the thing is, I think it's fair because I checked and I got to know that both Interactive Brokers and Tastyworks, which I also have an account, they already passed this fee to me ever since, from day one. When I opened the account to them, every time I trade SPX, they charge a different commission because the commission has the fee inside, so it's higher. So it's fair. I think it's fair. Just move on. Finally, I just have a few closing thoughts I want to share with you. Number one, why the return on investment for this particular strategy is very lucrative, right? Very good. SnipeX is not the strategy where you can just enter and go away. Okay, just to be clear, you cannot just enter the SnipeX trade and go for 1 week vacation without looking into it. Anything can happen. I carry my laptop on the way when I'm on holiday just to manage my SnipeX most of the time. So that's the trade-off. You cannot just enter and forget. you have to monitor it. If you cannot monitor it on the daily basis, don't trade it. Don't trade this strategy. Number two, I've been testing this one for 4 months now, I told you, throughout different market conditions, trendy, stagnant, slightly drop, but it has not been tested in a very volatile market, the extreme volatile market, like SPX dropping like 50, 60 points a day. I have not tested in that market condition yet. I think during that 4 months, the maximum loss of SPX is 40. There was one day when Iran shoot the missile to the US Army, then the pre-market dropped like 60, 70 points. I was hoping that is the case where I can test this strategy, but when the market opened, it was green again, right? So have not been tested in that extreme condition. My guess is if the market crash, yes, I will be hurt by the delta moving so much down, but the volatility will increase. My SD range will also expand, and probably it's okay. I think it's okay. My worry is if it moves $50 or $60 up in one day. That is maybe the worst case for me. Because in that scenario, IV or VIX tend to drop also. So I get both Delta and Vega hurt at the same time. But if it crash like 50, 60 points, I think it's maybe fine. Okay, let's see it. So cautiously watch it. And that's also the last one I want you to keep in mind. Trade cautiously and don't be greedy. Meaning when you have 100% profit, 150%, 200% profit, and still like 10 days away, take the profit and move on. Okay, you can use that capital for a new trade. Don't like be too greedy waiting until the last day or last few minutes before the expiration to get the max of the theta decay. The whole profit can be wiped out. Just let you know. So don't be greedy and don't put all the money into this trade. Okay, just be balanced between this and other position in your portfolio. With that, I leave the thoughts with you, and hopefully you find this helpful. And if you have the chance to watch this one, and we have the upcoming Q&A webinar, you can ask me or Adam more about the trade. Happy trading.